Monthly dividends, 98.5% occupancy, over $80 billion in real estate. Realty Income is one of the most popular REITs out there, but is it still a smart investment in 2025? Let's break down what they do, their financials, and the latest Q1 report. Realty Income got its start in 1969 with a single investment in a Taco Bell. Today, the retail REIT owns thousands of properties across America, leased to hundreds of tenants operating in dozens of industries. Retail properties account for most of the firm's rental revenue, with industrial warehouses and gaming venues generating almost all of the remainder. All properties are under long-term, triple-net lease agreements, which shift property operating expenses to tenants and generate predictable cash flow to fund monthly dividend payments. Realty Income currently pays an annual dividend of $3.23, distributed monthly. The next dividend payment will be on July 15th, and anyone who owned the stock by July 1 is eligible to receive it. The starting dividend yield at the current price is 5.6%, compared to the 5-year average of just 4.81%. The price-to-AFFO ratio is currently 13.5, while the 5-year average is 16, and the sector average is 14.9. The expected price range is somewhere between $60 and $74, while the current share price is around $57. Based on this, the company may be slightly undervalued. Over the past 12 months, the dividend was increased by 3.2%. The 5-year average dividend growth rate is 2.9%, while the 10-year average is 3.6%. The dividend has not been cut in 56 years, and it has been increased every single year for the past 30 years. The FFO payout ratio has consistently remained below the expected 90% threshold in recent years, and in fact there's been a noticeable downward trend. FFO per share has been growing steadily year over year, a crucial factor for future dividend increases. Over the past 5 years, it has grown by an average of 5.2%, which is well above the dividend growth rate. This has given the company some breathing room to acquire or renovate more properties, or even to raise dividends more aggressively in the future. Like most REITs, Realty Income continuously issues new shares to help accelerate portfolio growth. What's reassuring is that the total sales chart also reflects this growth trend. As a REIT, the company is required to pay out a large portion of its income as dividends in exchange for favorable tax treatment. That's why the number of outstanding shares increases year after year. The capital raised from new shares, along with debt, is used to expand the portfolio. This means more shareholders to pay dividends to. But as long as revenue grows at the same pace or faster, there's no reason for concern. In the past, the company's debt levels were slightly above what's considered healthy, but that seems to have been addressed and hopefully will remain under control long term. The interest coverage ratio has also consistently remained above the expected level for the past 10 years. Realty Income is currently available with a starting dividend yield of 5.6%, and the dividend has increased by 3.2% over the past 12 months. With a credit rating of A-, the dividend appears to be safe, and further dividend increases are expected going forward, just as they have been in the past. Disclaimer: this video is for informational and educational purposes only. It does not constitute financial advice. Always do your own research before making any investment decisions, and never base a financial decision solely on the content of this video. Now, let's dive into Realty Income's latest quarterly results, Q1 2025. The numbers show strength, consistency, and resilience, exactly what you'd expect from a dividend aristocrat. In the first quarter, Realty Income invested $1.4 billion in properties. $893 million was deployed in Europe with a 7% cash yield and $479 million in the US at 8.3%. This results in a strong weighted average cash yield of 7.5%. Adjusted funds from operations per share came in at $1.66, up 2.9% year over year. Occupancy remained exceptional at 98.5%, reflecting the quality of their real estate portfolio. They executed 194 lease renewals at a rent recapture rate of 103.9%, meaning they were able to re-lease space at even higher rents. On the disposition side, 55 properties were sold for net proceeds of $93 million, showing good capital recycling. For the full year 2025, Realty Income reaffirmed their AFO per share guidance of $4.22 to $4.28. This consistent outlook demonstrates confidence despite macro uncertainty. Liquidity stood at $3.1 billion and their balance sheet remains solid. Realty Income holds an A3/A- credit rating with a net debt to EBITDA ratio of 5.4x, and 94% of debt is fixed rate, reducing interest rate exposure. Overall, Realty Income continues to perform like a textbook example of a reliable REIT: steady dividends, conservative balance sheet, and consistent operational execution. Let me know in the comments, do you hold Realty Income in your portfolio, or are you waiting for a better entry point? What if I told you there's a stock that's flying under the radar, pays you over 3% in dividends right now, and grows that dividend by 10% every single year? And no, it's not some risky startup, it's a stable utility giant with a clean energy twist. I'm talking about NextEra Energy, ticker symbol NEE, and in this video I'm going to show you why this might be one of the most underrated dividend plays of 2025. Founded in 1984 as Florida Power and Light, NextEra Energy changed its name in 2010 to better represent its aggressive push into renewable power. The company owns the largest electric utility in Florida, serving more than 12 million people. NextEra Energy is also the world's largest producer of wind and solar power, selling the electricity generated from these assets under long-term contracts to utilities and other businesses. The company is currently available with a starting dividend yield of just over 3%, compared to its 5-year average of only 2.31%. Its forward price-to-earnings ratio is 19.1, which is below the 5-year average of 25.8 and only slightly above the sector average of 18.7. The fair value of the company is estimated to be somewhere between $88 and $108, while it's currently trading around $73.88, making it appear undervalued. The company currently pays an annual dividend of $2.27, distributed on a quarterly basis. The next payment is scheduled for September 16th, and anyone who owns shares by August 29th will be eligible to receive it. The most recent dividend increase was 10%. Over the past 5 years, the average annual increase has been 10.5%, and over the past 10 years it's been 11%. For the past 29 consecutive years, the company has paid and increased its dividend every single year. The company consistently keeps its payout ratio well below the preferred 75% level, even with such strong dividend increases. This suggests that similar year-over-year dividend growth is likely to continue in the future. Earnings per share has been growing steadily year after year, with an average growth rate of 9.8% over the past 5 years, which essentially supports the ongoing dividend increases. The company issues new shares each year, but this is completely normal for a business like NextEra and helps fund its capital investments. Return on equity hasn't been particularly strong in recent years, but there's no major cause for concern, and the same goes for the return on invested capital. The operating margin consistently remains above expected levels year over year. As for debt, it's an area that may deserve more attention in the coming years, but given the current economic environment, it's not surprising that leverage has ticked up a bit. Personally, I believe that once the situation stabilizes and the Fed eventually begins cutting rates, the debt picture should improve, though that likely won't happen in the immediate future. The company is currently available with a dividend yield around 3%, which represents a rare opportunity, especially with expected dividend growth of around 10% going forward, just as we've seen in the past. It holds an A- credit rating, which is considered strong, although some micromanagement may be necessary due to the current high interest rate environment. Overall, the dividend appears very safe, and the company looks undervalued at current levels. NextEra Energy kicked off 2025 with strength. Adjusted earnings per share increased by nearly 9% year over year, reaching 99 cents compared to 91 cents in Q1 2024. That's impressive growth for a utility company. One of the things that sets NextEra apart is its massive renewable energy pipeline. In Q1 alone, they added 3.2 gigawatts of renewables and storage to their backlog, including solar, wind, and batteries. They now expect to operate over 70 gigawatts of generation and storage by 2027. That's one of the largest clean energy portfolios in North America. Now let's talk dividends. NextEra continues to target 10% annual dividend growth through at least 2026, and they've grown their payout every year for more than a decade. What's backing up this dividend? Strong operating cash flow. The company expects it to grow at or above the EPS growth rate of 6 to 8% annually through 2027. That means this isn't a stretched or risky dividend. It's well supported by the business fundamentals. Despite this growth, NEE trades at a historically low valuation due to market concerns over interest rates and utility sector headwinds, but the fundamentals remain strong. In a world shifting rapidly toward clean energy, NextEra Energy is building the infrastructure and scale to lead the way, while still rewarding investors with consistent, growing income. That combination, growth, yield and stability, is hard to beat. In this video, we're going to take a closer look at a company called Capital Southwest. Together, we'll try to answer the most important question: is it worth investing in or not? Founded in 1961, Capital Southwest is an internally managed business development company that invests in middle-market companies. It primarily provides credit and buys equity in companies across diverse industries like industrial manufacturing, healthcare, and technology services. The firm invests in growth financing, acquisitions, and buyouts, usually through various forms of debt and equity. Capital Southwest prefers non-control investments and often partners with other investors to strengthen its investment strategies in North American companies. The starting dividend yield is currently 10.88%, while the 5-year average has been 9.82%. The price-to-earnings ratio stands at 9.2 compared to a 5-year average of 9.3 and a current sector average of 11.6. The expected price range is between $21 and $26, while the current share price is $21.34. Based on these figures, the company appears to be fairly valued at the moment. Capital Southwest's next dividend payment is scheduled for June 30th. To be eligible, investors must have purchased shares no later than June 13th. This will be the last time the company pays a larger quarterly dividend. Starting in July, they will switch to a monthly dividend schedule. In addition to the monthly payouts, special dividends will continue to be paid on a quarterly basis. Over the past 10 years, Capital Southwest has increased its dividend by an average of 27.7% annually. In the past 5 years, the average increase was 7.6%. And the most recent raise was 3.1%. This shows a clear downward trend, but given the current high starting yield, that's not surprising, nor should we expect significantly larger increases. That said, the dividend does not appear to be at risk at this time. Companies like Capital Southwest typically distribute a high percentage of their earnings as dividends. Currently, the payout ratio has been near the upper limit for several years, but they've generally managed to keep it just below that threshold. In the long term, there is an overall upward trend here as well. However, the most recent full fiscal year performed worse than expected, and based on the forecast for the next 12 months, this short-term downward trend is likely to continue. This chart also shows that revenues have currently declined, but it's difficult to draw far-reaching conclusions based on just 1 or 2 weaker financial years. Capital Southwest, like other BDCs, continuously issues new shares to raise capital more quickly. This is completely normal for companies in this sector. Return on equity has been quite volatile over the past few years, which isn't the most reassuring sign. However, on average, it has managed to meet expectations. Return on invested capital has yet to reach the desired level, but the long-term trend offers some cause for optimism. The debt level appears to be slightly high, but it still remains within a manageable range. The interest coverage ratio also looks solid. The starting dividend yield is currently 10.88%, with a recent increase of 3.1% over the past year. In addition, special dividends are paid out quarterly. The dividend does not appear to be at risk at this time, making the company fairly valued at its current price. In today's video, we're going to take another look at a company called Rexford Industrial Realty. I already made a video about this topic earlier this year, and many of you really enjoyed it, but some of the information there might be outdated by now. So let's refresh our knowledge and see what's new with this company. Founded in 2013, Rexford Industrial is a real estate investment trust, REIT, that owns over 300 industrial properties like warehouses and distribution centers across Southern California, one of America's most land-constrained and supply-limited markets. The region's dense population and proximity to shipping ports make it a crucial hub for logistics, while the scarcity of developable land creates significant barriers to entry for new competitors. Rexford Industrial is currently offering a starting dividend yield of 4.69%, while the 5-year average is just 2.33%. The price-to-AFFO ratio stands at 18.4, compared to a 5-year average of 32.5 and a current sector average of 15.1. The stock is once again approaching the lower end of its 52-week price range. The expected fair value is estimated to be somewhere between $58 and $71, while the current share price is just $36.70. Based on these numbers, the company appears to be undervalued. The company currently pays an annual dividend of $1.72 distributed on a quarterly basis. The next dividend payment is scheduled for July 15th, and to be eligible, investors must have held the stock no later than June 30th. Over the past 10 years, the average dividend increase was 13.3%, and over the past 5 years, it was 17.7%. However, the most recent dividend raise was only 3%. While the current dividend and future increases do not appear to be at risk, it's understandable that the company has scaled back its dividend growth in response to the current economic environment. Rexford Industrial currently pays dividends at a maximum limit of 90%, but what is even more important is that they have managed to keep dividend payments under control over the past 10 years and have not overextended themselves. This is reassuring to see from an investor's perspective. Based on current forecasts, there will be a slight decline this year, but it is reassuring to see that the long-term trend is definitely positive. Here we can also see that the company has been able to steadily increase its revenues year after year. This year is expected to perform a bit worse, but it is not yet worth drawing any far-reaching conclusions, especially given the current economic situation and the Trump administration's policies. REIT companies like Rexford Industrial typically issue new shares year after year to fund dividend payments, while also retaining cash for property maintenance and expansion. As the chart shows, Rexford Industrial struggled with debt to a small extent in the past, but thanks to responsible management, they managed to recover from it. Currently, the level of debt is very healthy, and the interest coverage ratio has been strong for years. Although there has been a somewhat concerning trend in recent years, this metric is still well above the expected level. Rexford Industrial is currently available with a record-high starting dividend yield of 4.69%. The most recent increase was 3%, and the credit rating is BBB+. Based on this, the company appears undervalued and the dividend seems very secure. However, a 10% dividend increase should not be expected in the coming years. Rexford reported a net income of $68.3 million, or 30 cents per diluted share, up from $58.6 million a year ago. Their core FFO, which is a key metric for REITs, came in at $141 million, or 62 cents per share, a 6.9% increase year over year. Net operating income also grew solidly, up 18.4% to $193.6 million. Their cash NOI, which removes non-cash items, was up over 20%, showing strong operational performance. Rexford signed leases for 2.4 million square feet, with a cash leasing spread of 14.7% and a net effective rent increase of 23.8%, both strong figures. Occupancy across the same property portfolio was 95.9%, which is solid and stable. That said, same property NOI growth was only 0.7%, a bit soft compared to historical numbers, although cash NOI growth was stronger at 5%. The company declared a 43-cent quarterly dividend and continues to maintain a conservative balance sheet. They have over $1.5 billion in liquidity, and their net debt to EBITDA ratio stands at 3.9x, which is comfortably low. Plus, no variable rate debt and no major debt maturities until 2026, so interest rate risk is well managed. Management reaffirmed their full-year core FFO guidance between $2.37 and $2.41 per share. They expect same-property NOI growth between 0.75% and 1.25%, and cash NOI growth between 2.25% and 2.75%. So, steady but not explosive growth. On the positive side, strong leasing spreads, solid cash flow growth, low leverage and excellent liquidity. Dividend looks sustainable. On the more cautious side, slower growth in same property income, no acquisitions this quarter. Some markets, like Ventura County, saw slight occupancy declines. So overall, Rexford continues to look like a steady, well-managed REIT, not flashy, but reliable. If you're focused on long-term stability and industrial real estate exposure, it's definitely a company worth watching. Let me know what you think about REXR in the comments, and if you're holding, buying, or just watching from the sidelines. And if you found this breakdown helpful, don't forget to like and subscribe for more investing updates. Thanks for watching, and if you found value in today's video, give it a thumbs up and consider subscribing for more smart, long-term investing ideas. Stay patient, stay consistent, and keep building your path to financial freedom. Until next time, take care and happy investing.